morning and welcome to this week's Market Carver. Happy Thirdly week. Some of you I will have already seen Tuesday night. The rest of you will be seeing hopefully Thursday night tonight when you receive this. Obviously a lot going on in the market. We'll talk more about it at the Thirdlies, but a few things of interest to us. One, we've been paying great attention to the car world, what's going on there. Average car on the road still a little over 12 years old. Surprising, we've talked about 53% of the cars that have been bought this year have been trucks, and of course you've got the Volkswagen story to go along with it. Well, this morning was a little bit interesting. The news we're going to talk about now is not about the car companies per se, but rather the fact that the loans are coming out the way they are. We're watching about 29% of the loans now come out at 73 to 84 month periods of time. I couldn't believe it. I know when we used to go get cars and they were financed, they were 48, 60 months at the most. Who would finance longer than 5 years? And yet 29% of them are between the 73 and 84 month period of time. Now what's challenging us in the automobile world is right now about $70 billion of those loans are what we would call securitized. In other words, the banks aren't keeping them on their own balance sheets. They're putting them off a lot like they did mortgages back in the '08 period. 21 billion of those are actually subprime mortgages. And so the comp controller, the currency controllers essentially come out and said, hey, we may be tightening some of the screws. Now, whether that means people simply pay a higher rate because they still want the automobile, have to have it if they're replacing it, or whether that really slows sales is something that we're going to have to watch going forward in the future. But let's contrast that $70 billion, that's for all the securitized loans for cars in the United States, with Puerto Rico, the small island that we're responsible for. You may know by now that they have $72 billion of municipal bond debt that's coming due, and they are flat broke. Because they're not a state, there's no Chapter 9. People have been wondering what's going to go on here. The Obama administration has said that they are stepping in to put through some legislation. What that means, we really don't know yet, but that is what we're watching, and obviously Puerto Rico is a dangerous part of the world from a financial structure right now. Now, October so far is on track to be one of the top performing markets in the S&P 500 in the last 4 years. Really had a huge rebound, and that's what you see above the hood of the car. One of the things that's concerning us, though, is that very much a large cap rally. Last Friday morning, Amazon, Google, Microsoft, three of the largest companies by market cap, actually came out. They were all up 10% in after hours trading, up more than 8.5% when the market opened. And so it looked like a wonderful day on the U.S. Stock Exchange. The problem is, based on breadth, and remember we talk about that a lot, based on breadth, the number of active participants, it was one of the lowest days in an upmarket day that we have ever seen. It was really interesting things, and again, not the kind of sign we want to watch. We want to watch a lot of participation or a lot of breadth. I spend a lot of time as my job on the macroeconomics worried about what's going on in interest rates around the world. And you've heard us talk Germany, up to a 4-year treasury you could get from Germany that was trading at a negative rate. That means you put in money and got less back at the end of the period of time. France was the same way. Italy and Spain, you may recall, were part of what we used to call the pigs. Portugal, Italy, Spain, and Greece, and all of the economic demise was going on over there. With things that are happening in Europe right now, Italy and Spain just took their 2-year mortgage, or their 2-year sovereign bonds to a negative rate. That's on the back of Mario Draghi talking about some ECB and some intervention that could take place in Europe in December. So again, a very different economic times across the place. We had one of our longtime listeners ask me about last week's Market Carver and said, hey Joe, can you explain this again because it just really seemed odd. Active managers are mutual fund companies that manage money where they have portfolios of many, many different stocks. And they, by law, have to tell us essentially what their 10 largest holdings are, and we're able to extrapolate what their lowest holdings are as we look at institutional ownership across the board. The interesting part about this year, and this is relative to the S&P 500, at the end of 9/30, at the end of September 30th of this year, the top 10 companies that the average active mutual fund manager held had actually earned 8.2% less than the S&P 500. Where the bottom 10, the ones that they held the least, actually had a return of 8.7% relative to the S&P 500. So more than a 17% spread between what they own the most of and what they own the least of. Just one of those things that we found to be very interesting. Hey, like I said, I look forward to seeing you at the Thirdly. If you're out and about on Saturday morning, don't forget to catch the radio show 9 to 10 on WQME, 10 to 11 on Sunday mornings on Shine 99, of course on WILO. 4 to 5 on drive time Thursday afternoon. If there's anything we can do to be of service, please don't hesitate to let us know. God bless. Have a great week. We'll see you again soon.